Okay, welcome back to Roast My Portfolio, where you've sent in your lovely investment portfolios. I give them a good roast, have a little look over them, and hopefully we can all learn something along the way and become better investors. Anyway, this portfolio has been sent in by Josh, and he sent over his Trading 212 portfolio, which is made into a nice little pie, and I'll put that up on screen now. We have 5 slices in this very tasty pie, and we have the following funds. This is all ETF, so there's no individual stocks and shares in this one. We've got the Vanguard FTSE Developed World Fund. We have Vanguard's FTSE Emerging Markets Fund. We then have 3 smaller little pieces here. So we've got the MSCI USA Small Cap Weighted Fund. We have iShares MSCI World Small Cap Fund. And then we've also got MSCI's Europe Small Cap Weighted Fund as well. Now, Josh is pretty much calling this one exactly what it is. So it's a global fund, but with a tilt toward both emerging markets and smaller companies. So as we can see here, we've got around 65% of the portfolio in that major developed markets. And then the rest, of course, is an overweighting, so more than deserved by market weighting toward those smaller companies and emerging markets. So first things first, there's probably no point going into that FTSE Developed World Fund. That's pretty much just got all of the same stocks in as most of these big global funds. It's going to have Apple, Microsoft, and all the rest of the big names. Funny enough, this fund, VHVG, has only been going for around 2019, so there's not a huge amount of data on that one. More interestingly, let's have a look what's in these smaller ones, because I'm quite curious. Let's just have a look quickly here inside this USSC. Now, if you're ever looking for yourself to find what ETFs actually got inside of it, it's really easy. Google, of course, is your best friend. So if you search for the USSC ETF in this case, you can actually see then under holdings what's actually inside of this ETF. So you can give you a bit of a flavor of what they've picked, either as part of an index or maybe as part of an actively managed portfolio. So briefly, let's look inside of USSC. Let's actually see what's inside of this ETF, what these managers, what they've kind of screened to pick as these small cap stocks. So top holdings for the fund, we can actually see it's for the Chesapeake Company, which looks to be around a $11.5 billion market cap. So that will give you a perspective of what they're classing as kind of these smaller companies. And interestingly enough, what you'll see here, this only makes up 0.5% of the fund. Now, that's a huge difference when we're comparing this to some of these large cap funds. If you see any global funds or an S&P 500 index fund, for example, because you're looking at trillions of dollars in the likes of Apple and Microsoft. Another interesting observation here is, of course, the top 10 holdings in this fund. If we look at now, and if we add up all these, we're roughly looking about just 5% of the total fund is in those top 10. Now, compare that to something like the S&P 500, which has a huge weighting toward the top 10 holdings, and you're looking a lot closer to 30%. So quite an interesting observation there, which means that your money in these smaller funds is going to be spread across a huge amount of companies, because of course there are loads of smaller companies out there compared to big giants where there are just a few. Now, here's the big question for everyone, I suppose. That this portfolio says that the emerging markets and small cap stocks are going to outperform the normal weightings of the market. So this portfolio says Josh thinks there's going to be more growth or faster growth, at least for his timescales, in small caps and emerging markets. So if we think about emerging markets, of course, you've got the biggest player in there, people like China, followed closely by people like Taiwan, India, of course, and between the three of them, they make up around 50% of the emerging markets. Then you have loads of the rest of the countries around the world with huge populations with potential massive growth in the future. And of course, with massive populations, what you're saying to the market here is potentially there's going to be faster growth in these economies compared to the US and Europe, for example, who are already, you're saying, well developed and potentially won't grow as fast, even though with their smaller populations and larger companies already. So just quickly, let's look at some of the data. If I look on screen now, we've got the MSCI Emerging Markets versus the MSCI World Index chart. So this goes back into the 90s. So as you can see here, this black line is the developed markets and the red line is the emerging markets. Now, as you can see through history, the black line for at least the majority of the time probably trumps over the emerging markets. But there have been certain periods of time, of course, when actually the emerging markets have grown a lot faster. And of course, this is all really going to depend on your own investing timescales and of course how you invest into the market. The problem with charts like this sometimes is it just suggests that you would have invested right at the beginning and never really contributed. So we are just kind of looking at averages over the long term. However, saying all of that and saying that developed markets, of course, okay, they perform better, so they must perform better in the future is of course very dangerous, because these past performance is not necessarily going to be a reliable indicator for the future. If the big companies and the developed nations have already performed very well, are they going to be able to sustain their growth, whereas the emerging markets potentially potentially who've been downtrodden a little bit have a huge opportunity to grow. And of course, who knows what the next 10 years or 20 years is going to take and how this graph might look. But certainly at the moment, you can see there's quite a big gap between the developed markets and the emerging markets in terms of their performance. Where we're going to go next? Anyone's guess. Now, according to some analysts, of course, we are expecting China's GDP, at least the growth, to surpass that of the US maybe in the next decade or so, or even quicker. If you have a look on this chart now, which we grabbed from CNBC, you can see the yellow line here is China's growth and the blue line is the US. Now, that yellow line from China has, of course, massively steepened, and at some point in the future is probably likely to overtake the US, at least in terms of growth perspective. However, on the flip side, what's more interesting, of course, is then when it comes to actually per capita or per person, what we're actually looking at is the US is far, far richer than, of course, those developing markets. So if I bring up this second graph now, we are seeing kind of per person that the US per capita, at least back in 2019, was at $65,000. So that's, of course, all of the services and goods added up in the country, divide by about 65,000 per person. Whereas in China, because you've got that massive population, although the GDP might be growing really, really quickly, it only actually amounts to about $10,000 a person. So you can interpret this as a good or a bad thing. Of course, you can say that China has a huge way to go, bringing out millions and millions of people out from rural environments into urban environments. Of course, more opportunity to sell them goods and services. And that really is your bet here if you're saying that emerging markets are going to outperform the developed ones going forward. And now let's just touch on small caps. So remember, this is just smaller companies compared to your big giants like Apple and Microsoft. Now, in the past, small cap stocks have tended to perform pretty well over a long period of time. However, they can be very volatile and very risky, because if you think about it logically, these smaller companies may have less cash at hand to actually kind of weather the storm, and maybe as well less established brands, and they've got to maybe spend more and more to get themselves into those competitive situations. So potentially those smaller companies can get wiped out if the economy takes a downturn. Looking at some more data now, because you know we love some data on this channel, I'm going to use the portfolio backtest tool and go back as far as we can, at least for these two ETFs. Let me just put up on screen now for you. This is a comparison of the Russell 2000 ETF with the S&P 500 effectively. So this blue line, which has maintained itself on top for most of this graph at least, is the Russell 2000. So that's going to be your smaller companies in the US when compared to the S&P 500. And after looking at this graph, you might just think, well, these smaller companies are going to wipe the floor with the S&P 500. Why not just put all of your money there? And of course, we'd never know what's going to happen in the future. This is just what's happened in the past. And in this one, of course, assumes that we've just put our money in at the beginning, which really not everyone's going to be able to do that. And it's really going to be a dollar cost average over a long amount of time. Now, a couple of observations here. Yes, we would have ended up with more money with our $10,000 initial investment. The Russell 2000 would have generated $51,000 and the S&P 500 would have generated $47,000. However, just pay attention to a couple of different metrics here. I know it's not going to be a massive difference, but you are going to have to deal with the ups and downs of these smaller companies. So as you can see, if you go over to max drawdown, you can see what the lowest point that the Russell 2000 would have suffered compared to the S&P 500. And yeah, sure, it's only a couple of percent. However, if you do find different parts on the graph, you are looking at some pretty bad dips. Now, if we go over here to around 2019, you can see you were sitting pretty with $44,000 in your Russell 2000 smaller companies index, and the S&P you were at 35, and then all of a sudden you were down here very, very close to each other just at the start of the pandemic. So that could be a big difference. Of course, you're losing about 30% there with your Russell 2000 and only about 20% there with your S&P 500. Now, of course, with all of these things, it's only ever a loss if you actually sell. If you are just dollar cost averaging for the long term, those dips don't necessarily matter, but it's all going to be up in your head as an investor if you can actually live with that volatility and live with the level of dips that you're going to have to do over the long period of time. So just bear that in mind with small caps. Moving on to fees, I'll put these up on screen now. Remember, all of your ETFs or mutual funds are always going to carry a fee. Nothing is free as in investing, and we want to try and keep these fees as low as possible because, as you might have seen from other videos, fees over the long run have a huge impact on what you might end up with, especially if you're talking about decades and decades of investing. In the past, we've seen lots of mutual fund fees, above 1%, maybe 1.5%. Luckily for investors now, fees have been squeezed with more competition in the market. And we've got kind of people like Vanguard and others to thank for that, for squeezing those fees down. But we still want to keep them as low as possible. On screen now, you'll see all the different fees we're looking at here. So VHVG is 0.12%, which makes up the majority of fund. And the rest are kind of hovering around that 0.3% mark, which, yes, you could argue that is slightly more expensive, but I'd be lying if I said anything in this pack was actually very, very expensive. 0.35% isn't really anything too expensive, but it does reflect the fact that these funds are going to have less investors' money in them, potentially less liquidity. I'm not too worried with these, to be honest. Nothing too crazy unless you're going to be a multi-millionaire. But at the end of the day, you do have to expect that they are going to pay you a small premium here to be investing into these smaller cap companies. All right, so what's the conclusion for this one? Well, no complaints here, I don't think. At the end of the day, this all depends on your expectations and where you think the future lies. What Josh is saying here with this portfolio is that he thinks that overall the developed markets will continue to shine and he'll have most of his money there. But in the developing market, in the emerging world and those smaller caps, he's betting a little bit more of his money to saying that in the future, he thinks he's going to get some more growth there. Is that going to be the case? Literally nobody knows. Nobody knows where the performance of the next decade or 20 or 30 years might come from. You could pull as much analysis as you like to confirm your bias either way. Anything could happen. But the alternative would be just to have a single global ETF or just investing in something like the S&P 500. So that really is your alternative to lower your fees and have less stress. But at the end of the day, it's your choice. It's up to you. You may even end up outperforming your peers and outperforming everyone by a couple of % each year over a long period of time, which really, really makes a huge difference, but nobody knows. Spice rating, Josh, I'll give this one another lemon and herb. I don't think there's anything too crazy in this one. Certainly no individual stocks or individual hype stocks here. Remember, if you do want to be featured on this show, please do check my email in the description below and send me over your portfolio. I'm looking forward to the person who sends me the most hype stock portfolio that they've lost 70% for this year. Don't be shy, send it over. Anyway, until next time, make sure you drop me a like on the way out, subscribe for many more. Thanks so much for watching, and as always, guys, happy investing.